Most people think retirement is decided by the birthdays everybody talks about. They think the big ages are obvious, 59 and a half because a penalty disappears, 62 because Social Security shows up, 65 because Medicare arrives, 73 or 75 because required minimum distributions start forcing money out of accounts, whether you need it or not. I do not think the most dangerous year is the year the system starts talking to you. I think the most important year is the last year before it talks. That is why I keep telling people that 61 is not a milestone. It is a deadline. If you miss what 61 gives you, you can still retire, you can still make good decisions, but you are no longer making them inside a quiet room. You are making them inside a room full of alarms, thresholds, look-backs, forced distributions, and benefit interactions. You are no longer writing clean instructions. You are negotiating with a machine that has already started moving. That is the difference. Most people spend their 50s and 60s looking at retirement the wrong way. They stare at the balance in the IRA. They stare at the brokerage account. They stare at the house. Then they ask a lazy question that sounds wise but is not wise at all. They ask, "Do I have enough?" I have never liked that question. Enough is not a number until you understand the system that will tax the number, reshape the number, and punish the number if you move it at the wrong time. $1 million handled badly can feel tight. A smaller pile handled strategically can feel powerful. What decides the difference is not only what you own, it is whether you used the last year of clean control before the retirement machine started pushing back. That clean control year is 61. I want you to think of retirement planning as a control room. At 61, you are still alone in that room. The switches are in front of you, the lights are calm, the dashboard is readable. You can decide how much ordinary income to recognize. You can decide whether to convert IRA dollars into Roth dollars. You can decide whether to harvest capital gains. You can decide how much income to show for health insurance subsidy purposes. You can decide how to shape the tax brackets you will live with later. At 62, another hand enters the room. Social Security is now on the board. Whether you claim or delay, the board is no longer clean. At 63, another system wakes up. Medicare's look-back starts casting a shadow over today's income decisions. By your early 70s, the room is not yours. Required minimum distributions start pulling levers for you. Your choices stack on top of forced income. The machine is now designing you. That is why I say 61 is the last quiet control room. Miss it, and you do not just lose a year. You lose clean geometry. You lose clean math. You lose the ability to layer decisions without interference. Interference is what destroys elegant plans. The first mechanism I want you to understand is what I call the quiet console. The quiet console is the rare moment when your planning tools still respond to one another without other retirement systems contaminating the result. At 61, there is no Social Security check available yet. That matters more than most people realize, because the minute a benefit becomes available, even if you do not claim it, your thinking changes. Every conversion starts being compared against a future benefit stream. Every withdrawal gets mentally filtered through questions about claiming age, taxability, survivor consequences, and whether you are shrinking flexibility later. At 61, that noise is absent. No provisional income headache is attached to the current year because there is no Social Security benefit in the room yet. You are not dealing with the long political mistake that left those thresholds frozen while inflation did the damage. You are not asking whether one extra move this year turns a clean tax picture into a partially taxable benefit picture later. You are still standing before the system crowds your desk. That is not a small advantage. That is a strategic advantage. People who treat 61 like an ordinary birthday waste. The quiet console, they drift through the year the same way they drifted through 58 and 59. They let inertia make the decisions. They say they will deal with Roth conversions later. They say they will optimize the IRA later. They say they will think about Social Security later. They say they will look at health insurance later. Later is expensive. I have spent my life around capital allocation. The best capital allocators do not wait until the good options are gone and then start congratulating themselves for making the least bad decision. They act while the field is still won is a wide field. The second mechanism is the bracket harvest. Most people think taxes are something you minimize year by year. That is amateur thinking. The real game is not to chase the lowest tax bill this year. The real game is to shape your lifetime tax path so you do not end up paying cheap taxes late with expensive dollars. Under bad rules, from forced distributions you no longer control. That is what the bracket harvest is about. Suppose you are 61, your earned income is gone or nearly gone. Your taxable income may be lower than it will be later. If you do nothing, that may feel safe. But doing nothing can be one of the costliest decisions in the entire retirement plan. Why? Because an empty bracket is not neutral. It is unused capacity. If you can convert traditional IRA money into Roth money at 12% or at the lower end of 22%, and you fail to do it, you are not preserving flexibility. You are often renting a future problem. Every dollar you leave sitting in the traditional IRA is not just a dollar deferred. It is a future forced distribution candidate. It is a future Medicare premium problem. It is a future taxable Social Security problem. It is a future bracket filling problem. That is the part people miss. They think avoiding tax today is automatically smart. It is not. Sometimes measured, deliberate tax today is how you prevent an ugly, stacked, involuntary tax tomorrow. I have seen retirees avoid a 12% conversion with the pride of a man who thinks he has outsmarted the government, only to arrive later with large required minimum distributions. 2 Social Security checks, more ordinary income than they need, and no room left to maneuver. Then they act surprised when the machine starts taking bites from every angle. This is why I say the tax code rewards people who move before they are required to move. At 61, the bracket harvest is clean. You can look at your standard deduction, your existing income, your gain exposure, your healthcare subsidy targets, and decide exactly how much ordinary income you want to manufacture on purpose. That is a very powerful sentence, and you should not miss it. You can manufacture income on purpose. That is the identity shift most people never make. During your working years, income happens to you. An employer decides the paycheck, the withholding, the rhythm, the bracket pressure. You adjust around it. In a well-designed retirement, you become the designer of income. You are no longer merely a saver. You are no longer merely a recipient. You become the architect of taxable space. That shift changes everything. The third mechanism is the shadow toll. The shadow toll is what most retirees do not see until it is already charging them. Medicare does not simply ask what your income is when you enroll. It looks back. That means a big income event can haunt you later. A Roth conversion that feels clean in 1 year can show up 2 years later as higher Medicare premiums. A poorly timed capital gain can carry a cost that does not arrive when you made the move, which makes it psychologically easy to underestimate. Human beings are very bad at respecting delayed costs. That is why credit card debt exists. That is why governments postpone hard decisions. That is why retirees wander into premium surcharges they could have avoided. The numbers do not need to be gigantic to hurt. Cross a threshold by a little, and the pricing does not care that you only crossed it by a little. The system is mechanical. It is not sentimental. It does not reward your effort. It only reads the line. That is why 61 matters so much. A large Roth conversion at 60 can be a pure bracket decision. A large Roth conversion at 63 can become a bracket decision plus a future premium decision. Same conversion, different room, different total cost. That is the shadow toll. And once you see it, you stop thinking in single-year tax returns and start thinking in multi-year control sequences. That is how rational adults should plan retirement. The fourth mechanism is the layering window. The layering window is the rare period when several valuable moves can be coordinated in the same year without one immediately wrecking the others. At 61, if you are not yet on Medicare and you are buying health insurance through the marketplace, you may be able to manage income for subsidy purposes. At the same time, you may be able to harvest capital gains at favorable rates. At the same time, you may be able to convert part of a traditional IRA. At the same time, you may be able to reposition future income so that your 70s are lighter, cleaner, and more flexible. That is not one strategy. That is strategy stacking. And stacking is where the real power sits. Anybody can memorize a rule. Very few people can coordinate multiple rules without letting one move cancel the benefit of another. That is why retirement planning feels simple from a distance and complicated at the kitchen table. A Roth conversion raises adjusted gross income. Capital gains harvesting raises adjusted gross income. Income affects healthcare subsidy eligibility. Later, income affects Medicare premiums. Later still, too much pre-tax money affects required minimum distributions and the taxability of Social Security benefits. The pieces talk to one another. That is why I do not respect advice that is technically correct but strategically isolated. Do Roth conversions. Maybe delay Social Security. Sometimes harvest gains, perhaps. Protect the AKA subsidy. Fine. All of that can be true and still lead you into a mess if the moves are not layered in the right sequence. At 61, you still have the best chance to layer without the system shouting back. That is why I call it a window, not just a year. Open windows do not stay open. The fifth mechanism is the 30-year echo. This is where most people finally understand why I am so intense about a single year. Retirement decisions do not die in the year you make them. They echo. A Roth conversion done at 61 does not just affect that tax return. It changes the size of the tax-free pool you own for the rest of your life. It changes how large your future required minimum distributions may become. It changes what options you have when markets fall. It changes how you pay for a roof, a car, a move, a grandchild's help, or long-term care shocks later. It changes what your spouse may have to work with if you die first. It changes what kind of inheritance you leave. That is one move echoing through decades. Now reverse it. A year of delay at 61 also echoes. No conversion, no gain plan, no income positioning, no reduction of future IRA pressure, no use of low brackets, no control over the shape of the next 30 years. That also echoes people think indecision is conservative. It is not. Indecision is usually just an invisible decision in favor of the default system. And the default system is rarely optimized for your peace of mind, your tax efficiency, or your family. It is optimized for administrative order. I have never met a retiree who wanted administrative order more than freedom. That is why the 30-year echo matters. If you arrive at 73 or 75 with a giant untouched ERA, the problem is not simply that you owe taxes. The problem is that the room gets crowded. Required minimum distributions start filling bracket space. Social Security is likely already on the board. Medicare premium thresholds are no longer abstract. The moves you wanted to make from a position of control now have to be made from a position of compliance. And compliance is expensive when you waited too long. There is also a psychological mechanism hidden underneath all of this that I consider one of the most important in retirement. I call it the driver's seat rule. During your working life, wealth accumulation feels emotionally easy to interpret. You are adding, building, climbing, producing, expanding. The account balance rises and you feel competent. Even when markets fall, the direction of your own behavior is still accumulation. Retirement is different. Now you are drawing down. Now money leaves accounts. Now every withdrawal can feel like decay if you do not have a plan. Now uncertainty feels personal because you are no longer blaming a boss, a company, or the economy. You are watching your own decisions translate into visible account movement that can rattle people. I have watched intelligent, disciplined adults become timid in retirement, not because they lacked money, but because they lacked system confidence. They did not know why they were pulling what they were pulling. They did not know whether this year's conversion was smart. They did not know whether they had just triggered a hidden cost. They did not know whether delaying Social Security was courage or stupidity. They were not in the driver's seat. They were riding in the back of a machine they did not understand. That is no way to live after a lifetime of work. The people who use 61 well do not just improve taxes. They improve emotional stability. They know what lane they chose. They know why they converted what they converted. They know why they showed the income they showed. They know what they are protecting. They know which future pressures they already reduced. Control lowers anxiety. Clarity lowers anxiety. Design cash flow lowers anxiety. That is why 61 is not just about spreadsheets. It is about dignity. Now let me make this practical. If I were 61 and I wanted to use this year the right way, I would not begin by asking, what should I do with my IRA? That is too narrow. I would begin by asking, what tax world am I trying to live in at 75? That question forces adulthood into the room, because once you ask it, you stop playing with isolated tactics and start designing a sequence. I would map my current fixed income. I would map the spending I actually want. Not the fantasy spending I tell myself is enough, and not the bloated spending of someone trying to impress neighbors. I would identify how much room exists in the lower brackets after deductions. I would calculate how much traditional IRA money could be converted without wrecking healthcare subsidies or creating avoidable spillover. I would look at taxable gains and decide whether harvesting some of them now improves future flexibility. I would model what my required minimum distributions may look like if I do nothing, and compare that against a world where I use 61 aggressively. I would look at my spouse, if I have one, not as a side note, but as part of the same financial organism. Survivor income matters, tax filing status matters, future control matters, and then I would commit to a written operating sequence. Not vague intentions, not mental notes. A written operating sequence. I would decide what amount of ordinary income I want this year. I would decide what amount of Roth conversion I want this year. I would decide what gain realization I want this year. I would decide what subsidy guardrails I refuse to cross. If subsidies matter in my case, I would decide what Social Security claiming path I am leaning toward, not because I must lock it in today, but because the current year should not be designed in ignorance of the next decade. That is how adults use a control room. They set the instruments before the weather changes. There is another truth here that I want to say plainly. The danger of missing 61 is not only financial, it is behavioral. Once people miss the clean year, they become more likely to delay again. At 62, they say things are more complicated now, so maybe they should wait another year. At 63, they worry about the Medicare look-back, so they become even more cautious. At 64, they are tired of thinking about it. At 65, Medicare enrollment becomes the headline. At 66 or 67, Social Security becomes the headline. At 70, 3 or 75, required minimum distributions become the headline. Do you see the pattern? They live from headline to headline. They never return to the quiet work of design. That is why the people who use 61 will often look almost unfairly calm later. They already did the hard thinking before the noise arrived. Everyone else is reacting in real time. Reaction is expensive. Design is powerful. I also want to make a point that many people resist because it offends their instincts. Sometimes the right move at 61 is to intentionally create taxable income. That sentence makes timid planners nervous, but I have no interest in flattering timidity. If a measured tax bill today buys lower lifetime taxes, lower future premium pressure, more Roth flexibility, cleaner survivor outcomes, and smaller required minimum distributions later, then paying tax today may be one of the best bargains in your entire retirement. People act as though the goal is to die having never paid a voluntary dollar of tax. That is not my goal. My goal is control. My goal is optionality. My goal is to own assets in the right wrappers, so future decisions are not made with a gun to my head. That is the mindset of an investor. And it is also the mindset of a retiree who intends to stay sovereign. If you want a simple way to know whether you are thinking clearly, ask yourself one uncomfortable question. If I do nothing at 61, am I preserving flexibility? Or am I just leaving my future self a heavier machine to manage? That question cuts through a lot of nonsense. Because for many people, the answer is obvious once they are honest. They are not preserving freedom. They are preserving delay. And delay is a disguised form of surrender. I want the opposite for you. I want you to use 61 to become the kind of retiree who understands the machine before the machine starts setting the terms. I want you to move from accumulator to architect. I want you to move from tax victim to tax designer. I want you to move from hoping your 70s will be manageable to deliberately making them manageable. That is the real identity change here. Not worker to retiree, not saver to spender, designer to design. That is the line. Cross it in the right direction. And retirement starts to feel intelligent. Cross it in the wrong direction. And retirement starts to feel like paperwork with emotional consequences. You worked too hard for that. You did not spend decades building capital just to hand the steering wheel to thresholds you never studied. You did not take market risk, career risk, business risk, and life risk just to arrive at the one phase where passivity suddenly masquerades as prudence. Prudence is not passivity. Prudence is preparation. Prudence is seeing the system before the system sees you. That is why 61 matters. It is the last year when you can still act before Social Security crowds, the board, before Medicare lookbacks cast a shadow over your moves, before required distributions harden the shape of your tax life, before small delays become a lifetime of reacting. I do not care whether your portfolio is modest or large. I do not care whether you are single or married. I do not care whether you think you are almost ready or nowhere near ready. If you are approaching 61, the year deserves seriousness. Not panic. Seriousness. Sit down with the numbers. Map the room, measure the bracket space. Understand the subsidy line, model the future required distributions. Decide how much pre-tax money you want to leave for your 70s and how much you would rather move under your own terms now. And above all, stop treating 61 like a warm-up. It is not a warm-up. It is your last clean look at the board. Every year after that, the board becomes noisier, tighter, and more expensive to rearrange. So here is the question I would put in front of you tonight. When the retirement machine starts talking back, do you want to meet it with a plan you wrote in the quiet or with excuses you invented after the controls were no longer yours? That is the real deadline at 61. Not a government deadline, a personal one, a control deadline, a dignity deadline, a future self deadline. And if you cross that year without writing your instructions, do not tell yourself nothing happened. Something happened. You left the control room unlocked, and the machine walked in first.